Inflation is up, unemployment is down, wages are up, the share market has been tanking, there's a rental crisis across most of the country, interest rates are rising for the first time in 10 years, and negative headlines about the property market seem to be everywhere you look. How can we make sense of all this?
Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent, co-host of Foxtel's Location Australia, and author of Auction Ready.
And I'm Chris Bates, mortgage broker. Before we get started, I need to let you know that nothing we say on here can be taken as personal advice. We always recommend you engage the services of a professional.
Don't forget that you can access the transcript for this episode on the website, as well as download our free full or forecaster report, Which Experts Can You Trust to Get It Right? theelephantintheroom.com.au.
Interest rates generally rise when the economy is strong, but with all the other negativity around, consumer confidence is at its lowest since April 2020. What does this mean for the property market? We've invited Eliza Owen, Head of Residential Research Australia at CoreLogic, to join us today to help us unravel what on the face of it appears to be a lot of conflicting information. Now, thank you so much for coming back on the podcast, Eliza. It's been a while, but I think this is your 7th visit. There's so much hype in the media at the moment over rising interest rates and falling prices and all the rest of it. We're just hoping that you can help us all calm the farm.
I'll do my best.
Thanks for coming along.
Thank you for having me again, Chris and Veronica. It's great to be here.
Look, I think, in one way, there is a bit of a, panic setting in, but a lot of it is sort of sound and, there is a bit of fear in the market, in terms of, mortgages are increasing for the first time, and quite big increases, in terms of the RBA rises, especially in the US market. So there's lots going on there, and I think it's important to sort of really talk it through. So if you could have to sum it up in a few sentences, I know it's really hard, but what's your sort of take on where we're at in, say, June 2022 and how far that's moved from, say, where we were late last year, I guess?
In terms of the housing market, growth rates peaked about March of 2021 and have been moderating since that time against affordability constraints. People just naturally not being as willing to pay more and more for property. But the downturn has been cemented by a lift in interest rates. I think for those who are less familiar with finance and the way that economics is kind of used to influence demand, is thinking of interest as the price of a mortgage. So if you think about it in basic supply and demand terms, when the price of something goes up, demand for it goes down. So whether it's because people can't borrow as much money or they're just dissuaded from buying in a higher interest rate environment, that's basically the relationship that we come back to when we look at interest rates in the property market. As you say, the interest rate rise is of strong economic conditions. So that's something that I think really underpins serviceability. When you come into a housing market downturn, you need to consider two major factors, which are equity and serviceability. If equity is falling but serviceability remains strong, it doesn't really matter that homeowners have assets that are falling in value temporarily. If serviceability is falling off but prices are going up, then that's kind of okay too, because if people really need to sell, then they can do so in a rising market. It's when both serviceability and equity positions are deteriorating that you've kind of got to worry. I don't necessarily think that would be the mainstream case for the housing market, but no doubt, I think between price growth, days on market, listings volumes, all of our metrics are corroborating the start of a downturn concentrated in our biggest capital cities at the moment.
Yeah, it's so interesting. You said, interest rates, the price you pay for the debt, and then the higher the price is, the less you want to take it on. You also, made a comment there around borrowing capacity, and this is something that people forget about, is that how much money you can borrow also determines, how much money you can spend, basically. And that's what's been pushing prices up a lot, because borrowing capacities have been going up as interest rates go down. As interest rates go up, borrowing capacities go down. So you can actually borrow less money. And this is a big thing. If the RBA increased interest rates from, 0, let's call it, or 0.1 to say 2%, which is, what's starting to get a feel of what it may do. And that's almost a 20% reduction in borrowing capacities. So it's a big reduction in how much people can borrow. And so that's another thing that's coming that isn't factored into prices today, because that rates haven't increased yet. Borrowing capacities haven't reduced, but as they increase, borrowing capacities will reduce. So that's something that we're likely to see play out as well.
In terms of how that unfolds, though, I'm curious, because there's been, data. I don't know where that data is from, and I don't know the amounts, right, the quantum of the data. But there's been talk of the fact that not everybody borrows to their maximum capacity. So does that mean that people then borrow to their maximum capacity, whereas previously in the lower interest rate environment they didn't? Is that what they do, or do they end up actually reducing their borrow? They still borrow under capacity, and so therefore they still borrow proportionally less?
Well, look, probably only about 1 in 5 borrowers borrow more than 6 times their income, which would probably be your max capacity or close to it, right? That had been increasing. So that increased from 1 in 5 to say 1 in 4. But it's likely to be maybe even those buyers can't spend that much anymore, right? And so that a quarter of buyers can't spend that much. They're going to have to reduce their budgets. But you're right, the other 80% or 70% of borrowers may have to stretch up to their max. And so you're not going to see a reduction in demand of all buyers, because not all buyers are spending to their max, but absolutely a big portion are going to have to reduce their budgets as interest rates go up. And so that's something that's, definitely needs to, in areas where you've got a lot of people stretching, a lot of people going 6 times, those are the areas, and have done that traditionally as well in the last few years. Young families that have, a lot of new high LVR loans, a lot of more than 6 times, they won't be able to refinance as well, because that's not only do you need that income to buy the property, but 2 years later when you want to refinance, you have to service under new rules, not the old rules when you purchased. And you're going to find issues there with coming off fixed rates, etc. So it's not doom and gloom. It's just something for people to think through is, interest rates are going up, but also borrowing capacities are reducing.
Yeah.
Eliza, do you have any data on what segments of the market are more vulnerable?
Yeah, I was going to say, this is like what Chris is talking to is a historic cyclical pattern that usually plays out in Sydney and Melbourne. So it's the high end and the central markets that tend to see declines first. Even looking at the combined capital cities, in the 3 months to May, the top 25% of values fell by about 1.5%. The low end of the market was still growing in value. So that's something where limited borrowing capacity might force buyers to look to the next affordable market that they can get into. So, for example, across Sydney, it's been the Northern Beaches, inner city, Sydney, Piedmont, those kind of higher end lifestyle areas that have seen declines first. And then as the cycle matures and more people are impacted by credit constraints, interest rates continue to rise, the downturn ripples out across the metropolitan. I think it's interesting at the moment because you've got not only rising interest rates, but some banks have also reduced their debt to income ratios that they're willing to lend on recently, with APRA kind of doing that bank by bank consultation. And so ANZ, for example, has come down from 9 times income to 7. So that's going to put quite a hammer on borrowing capacity, particularly for, say, multiple property owners who might be taking advantage of those kind of DTIs.
Yeah, you're absolutely right. So we're actually seeing that. We're seeing, I was even at the conference this week, with the head of one of the banks sitting down having dinner with, and the APRA are really behind the scenes are putting a lot of pressure on them with any loans over 6 times. And they've got to have a bigger capital weighting. It means that they have to price it more expensive. They can also have to only have a portion of their loans under that sort of higher DTI. And so absolutely, that's borrowing capacity is a form. But also, if you are looking to borrow more than 6 times, like close to your capacity, you're going to find pricing's not going to be great. And you're going to find it hard to actually get those loans, because a lot of banks are going to start really not going to want to do those real high debt loans. So it's
I think for some markets, and APRA kind of pointed this out as well, that falling prices can be good in the sense of it will reduce the DTI lending, especially in an environment where, wages, albeit slowly, are going up. And some people will have accumulated a lot of savings over the course of the past couple of years as well. So their savings might be representing more of a deposit as a property. So for people who want to make that kind of counter-cyclical move, it could actually be a really interesting, or really good time to buy.
Well, that's usually the best time to buy is when everyone's not buying. But that's the thing, isn't it? Nobody tends to buy when everybody's not buying. But also there's a challenge in I find the challenge anyway is that there's less quality stock at those times as well. So you do get a reduction in listings, and you do get a reduction in sales volumes, which actually makes it look like there's more listings, but there's often a higher proportion of crap out there. So it's all fun and games, isn't it? Actually, a bit of a sideways move on this. Some of these APRA moves and also just general interest rate increases and the impact on borrowing capacity. We do have a rental crisis in this country, and it does appear that this has been brewing for some years and it's really biting now. Will rising interest rates really exacerbate this problem? Or will investors who are foolishly buying just for negative gearing suddenly think, oh, great, I can save more tax?
So usually property prices and rents have broadly moved together, but it is interesting. We're in a time now where rents have been rising pretty consistently against a softer housing market. Gross yields have been rising as a result. For the past 4 months now, rents have outpaced growth in purchasing values. So I think in areas where investors can still get in, have a good yield, and not get anywhere near those DTI limits, there could actually be a opportunity and a bit of an investment strategy there. But the rental demand is really interesting because Lucy Ellis gave an address at the UDIA National Congress the other week and showed off some research that they'd done within the RBA about household formation falling through the course of the pandemic. So average number of people per household fell. And the proportion of people living in share housing dropped off pretty significantly. So this suggests that rental demand has largely been domestic and, well, obviously through COVID, and it's also been reactionary. People could afford to break up their households and get their own space because at the onset of the pandemic, there was a bit of a shock to rental demand initially. So in some instances, rentals were cheaper. Now that's kind of all corrected, but what remains is that people are reactionary. So we could see the reformation of share houses, for example, over the next couple of years in response to rising rents, which were up about 10% over the past year. It's just the highest rent growth we've seen since the early 2000s. It's extraordinary.
It is, isn't it? Because rents are usually capped by incomes, aren't they? I mean, in a way that, your borrowing capacity is capped really by the interest rates, as we're talking about. If you don't earn more money, you can't pay more rent. It is interesting too, anecdotally on the ground, we've just suddenly noticed some of our clients that had apartments coming up for releasing in the inner west in particular, and the numbers going through open houses and multiple offers and multiple applications. And we haven't seen that for a couple of years, right? And it's really interesting. And it was like, why? And we'd heard anecdotally it was because of that sort of the share households have broken down. A lot of these people have gone back to live with their parents through various lockdowns. And then now they're saying, bugger that, get us out of here, but we don't want to go back into share living.
Yeah.
So,
absolutely. I think especially as work from home has, or at least that hybrid model has become more mainstream, people would rather a home office than a housemate in their second bedroom. So that relates to a lot of people's experience. And then having Lucy Ellis present that kind of affirmed the narrative with some data, and the fact that breakdown in household formation added to housing demand to the tune of about 140,000 dwellings over the COVID period, which largely offsets the demand that you would actually get from international migration, overseas migration. So the challenge there is that rental markets have tightened up significantly, and we're only just welcoming back overseas arrivals. It was February that we loosened the travel restrictions around COVID. So with migration coming back on top of tight rental markets, I think there's going to be a period of pain for renters. and a period of opportunity for investors.
Yeah,
But
and I
migrants
guess we had
will-
massive amount of first home buyers buying as well, right? So the last 2 years we've had, say 400,000, let's call it, and that's a lot of first home buyers were renters before they bought their house. I mean, some have been living with their parents and saving the deposit, but a lot of exited the rental market and now become, buying. And I mean, that would be taken. A lot of them probably potentially buy off investors as well. So it's like a double, one investment property less, and then they're one rental less.
Potentially,
so
yeah.
net's probably the same. But yeah, I mean, if that didn't happen, then you'd find that the rental market would even be stronger, right? And as less first home buyers buy, that means they more have to rent. Plus, you've got migration, and so you could easily see this tightening of rental markets even further, and that's just going to keep on pushing rents up. But I think you're really interesting. You've made a point there where shared houses, yeah, they do break down because of the COVID, because it's more affordable. But then, if you got fuel prices going up, you've got food, and you go, look, I've got this one bedroom apartment and it's $550 a week. If I go move in with a mate, it's $350. Those sort of things will start coming back on the table, won't they? Because it's their only option.
Yeah, exactly. I think people will just have to. I also think, to your point about first home buyers, we've seen about 140,000 places that went to home builder, and construction pipelines have been blown out because of what's happening in that space at the moment between material supply constraints, labor supply constraints, and just the massive amount of work that's on. Those people who are waiting for their new homes to be built have to live somewhere as well. So that could be something that's adding to rental demand in the short term. And exactly that. I think, it gets to a point, especially now, because we've got headline inflation up about 5% over annually. And the non-discretionary items, so the stuff that people can't really cut back on, like energy, transport, food, those things have risen at twice the rate of non-discretionary items. Of discretionary items, rather. So it's a real kind of pain point for renters especially, and rents contribute a lot to that inflation figure as well. So I think we will probably see more shared household formations, particularly as that overseas migration flow starts to pick back up again as well.
That's interesting, because I was going to ask you, how long should it take for interest rate rises to have an impact on consumer spending? But a lot of this inflation isn't purely a result of spending, is it? And then you've got what you're saying there about discretionary spending versus non-discretionary. That's quite scary, really, because you think, well, if you can't cut back on your non-discretionary, and that's had double the inflation of discretionary, I'm getting it right, then the impact, therefore, of rising interest rates is really going to take a lot longer to take effect, isn't it?
Yeah, look, I think so. We do see some of the major banks are already talking about when the interest rate cycle starts to normalize again and starts to come down again. And some people are putting that, or some organizations are putting that at around late 2023, early 2024. So, I mean, we've got to remember this is all part of a cycle. The RBA is trying to get the economy to crash. They're trying to get inflation back to target of 2 to 3%. Housing is a big way of doing that. And as you say, that some of that discretionary spending is a big way of doing that. But overall, it doesn't necessarily spell doom and gloom for the economy or the housing market or the financial system. It's kind of a temporary pain to get back to that inflation target.
Yeah, it is interesting. A lot of people don't know that that's what a lot of the banks and a lot of, Jarden came out on Friday. Carlos, who's been on here, did a whole report on this. And you're right. Like it's a lot of people are thinking that rates are going to go really fast and hard. The RBA's probably realised they've left it a bit too late. They've got to play catch up. That's what the 50 basis points was. Maybe it's another 50 or whatever next month. But let's get it under control, and then maybe economy starts stalling. Because of the pressure on households to cut back spending, the wealth effect, etc. Rates normalise, and assuming there's no crisis, maybe rates have to fall if we start to get slower increases in unemployment and etc. So it's not like it's gonna. They're not forecasting rates to just keep increasing for 4 or 5 years. A lot of people think they're going to potentially stop sometime next year, rather than just keep going up.
Did you watch there was a Lee Sales on 7:30 report earlier this week, and bearing in mind, obviously this episode will come out in a few weeks after we're interviewing you, but she interviewed Philip Rudd. Philip.
Yeah.
Thank you, Philip Lowe, the governor of the RBA. Did you watch that?
I've seen snippets.
That interview? Yeah, it was really interesting. I mean, he doesn't often give interviews, and he really took great pains to try to to explain sort of these basic fundamentals. And I found it quite interesting that my take on it was that, look, when we said we weren't going to raise rates until 2024, and everyone ran off and made decisions and based all their confident, their level of confidence on that, we were saying, as long as things don't change, and that's the bit that didn't seem to make any headlines. And to be honest, I didn't pick up on that nuance either. I was thinking, wow, they're pretty confident coming out there saying that they're not going to do something. Well, that's pretty, we should be able to base some decisions on that. But clearly you can't, right? You got to base your decisions on other things. But the other thing too, I thought was interesting. It was like, well, we're going to keep doing it. We're going to keep raising these rates until it has effect. And then we might overshoot the mark a little bit. We might have to then drop them a little bit as well. I mean, this is sort of, it's a trial and it's basically trial and error every month, isn't it, really?
And every month is a good point. Other central banks don't meet as frequently. So we do have the luxury of seeing pretty quick adjustments to monetary policy conditions if need be. The other thing that RBA was stressing throughout the rate cutting phase of the cycle was the importance of lending standards and assessment. I mean, you are going to have a much better time if you can really conservatively borrow. That's why APRA came in October last year from increasing the serviceability assessment buffer from 2.5% to 3%, because if we do see that 3% cash rate rise, that's probably going to be passed on in full to variable rates. So that's important to keep in mind. And that
just on that point, Eliza, with APRA, I mean, when the market's getting out of control, we always say, "Oh, do something to slow it down," right? And they're like, "Well, we can't increase interest rates because we want to keep the economy growing out of COVID, right? And keep reducing unemployment so we get wage increases, right?" So what we'll do is we'll get APRA to come in and we'll increase the buffer, right? And we were very vocal on this. We said that's not going to do anything. What's going to slow the market down is when interest rates jump up. And then we all got shocked a little bit how much interest rates jumped at the start of this year, or the conversation, the fixed rates jumps because of inflation really took off around the world. But what's your thoughts there? I mean, that's the obvious tool that if we do see, and I agree with Northern Beaches, we've already seen prices fall 10+%, if not more, in some suburbs. And especially the poorer properties have really come back, aren't selling, and you're probably seeing some things in the West, Veronica. Certain properties have probably come back a little bit, and yeah.
Do actually, absolutely, but and Eliza, maybe you can put some insight to shed some insight in this. I was just looking. I did a presentation for my clients. I recorded it yesterday, and I'm really looking at sales volumes, listing numbers, and that sort of stuff, and the things that do correlate with falling prices versus the things that don't necessarily correlate with falling prices. And SQM has these great little charts about volumes, sales volumes, and listings volumes over the last 12 years, and it breaks it down into proportion that are 180 days or more. 90 days or more, 60 days or more, and 30 days or more, whatever. If you look at that, the 180 days or more definitely expands. It's visible. You can see with every downturn that proportion of the listings on the market absolutely extends. And so same between sort of the next bar, which is 120 days, right? Yeah. Those two bars are bigger. There's more stock in those bars, but the actual, you look at the sort of the up to 60 or 90 days, those bars roughly look fairly consistent in their length, right? So the volume of property on the market at any given time in those bars seems to be quite consistent regardless of what the market's doing. So what is it that takes longer to sell in a slow market? It's the shit property. It's the shit property and it's the overpriced property. And so what that means, a hot market is forgiving. Everything gets competitive. Buyers fight over crap they would never touch with a barge pole in a slow market. And so the problem with that is that skews lot of data. It's a little bit like also the top to the 25, the top 25th percentile is the segment of the market across the country, particularly in Sydney and Melbourne, that has had the biggest falls in the last 3 months, right?
Yeah.
Like you were saying earlier, Eliza. So of course, with every fall of a multi-million-dollar property in terms of value, that's going to actually have a bigger impact on the aggregate data, right?
Yeah. So the high end, I think that's really interesting, by the way, that that looking at the length of the listing or how stale it kind of gets in a downturn, that's definitely one I'd love to have a look at with our data. The high end is basically more volatile. So it sees higher highs. It also sees lower lows. In February of 2020, the RBA put out a research paper looking at basically the different nature of different value segments and theorized that the high end is more sensitive because people are more stretched when they're borrowing in those areas. So changes in the credit environment create deeper declines at the high end of the market. That's true for Sydney and Melbourne. It's true for the combined capitals. And it's something that we're seeing pretty consistently at the moment. Investors are another one that don't tend to pay down their debt as quickly as owner-occupiers. So those markets can be a little more sensitive to changes in credit as well.
Yeah.
But long run,
but the first home buyer, but also the first home buyers. But I guess they were such a small proportion of their total market, isn't it? That's the problem, isn't it? They're like 1% of the total dwellings is first home buyers on an annual basis, right?
Yes.
So therefore, the very fact that they are more vulnerable to interest rate rises and they're more vulnerable, they're potentially with negative equity if they've had 5% deposits and things like that, they would be under pressure. But I guess because it's such a small percentage of the entire market, it's not going to be reflected in the numbers, right?
My understanding is that first home buyers are a little more vulnerable in the first few years of their mortgage, but they actually tend to pay down debt more quickly. So they tend to be a more kind of secure segment of the market as it matures over time. And the other thing is, like, not every first home buyer is going to be borrowing to that maximum capacity. And to your point, Chris, I think I agree. Like when we first saw APRA's intervention come in 16. Sorry, I'm thinking last year. It was 20. This whole past few years has just been one great blur. But October last year, at the time, we thought, oh, that's kind of underwhelming. Now it's critical because actually interest rates could be going up by that much. So it was critical that people were assessed at that slightly higher buffer.
Unfortunately, that was a little bit late, right? Because it's only assessed people from November, I'm pretty sure. It was like November, December. And a lot of people, their pre-approvals went through till January, and that's when they had to get reassessed. So there's only a small number of buyers. And then those buyers all got freaked out anyway because they started to see fixed rates jump in January, February, and then they reduced their budgets. The thing what we noticed with first-home buyers is the people who are actually out buying are the people who are quite in stable jobs, are quite confident of their incomes in the next few years, have been saving money pretty well for the last few years, and back themselves. Basically, you don't. If you're really worried about your job, you haven't been able to save, you're worried about your bills, you're not out in the property market, right? And so generally, we're not seeing a massive slowdown in the number of people wanting to buy, but what we are seeing is they're very concerned and they are nervous and they're worried about interest rates and they're worried about buying something that may be cheaper in the future. And whereas last year they were worried about prices increase. If I don't get in now, right, the FOMO, it's the opposite. But they're still there. Like they still want to buy. They haven't, for example, just said we never want to buy. They're just being really picky and patient. But there's still probably what's also saying is a lot of people are getting wage increases. And so when I said at the start of this is where borrowing capacities are falling, well, that's assuming there's no increase in income. If you get a 5 or a 10% increase in your income, absolutely you get a massive bump in your borrowing capacity. And that, I think, is going to offset the reduction in borrowing capacities. But do you think APRA is going to unwind that decision? Because if interest rates jump 2%, do they still need to have a 3% buffer after a 2% increase in interest rates? They could have an argument to say, well, we've already protected you from 2%. Why don't we reduce the 3% buffer down to 2%? To basically stimulate the property market, especially if you start to see these falls start to cascade through the whole market and the wealth effects start to kick in. Do you think something like that's likely next year, Eliza?
It'll probably depend on debt to income at the aggregate level, because part of the reason these interventions or these recommendations around DTIs came into place was because through 2021, we got to a period where housing debt was growing faster than income. And that's not a sustainable situation. So I imagine they'll be keeping a pretty close eye on debt to income ratios. As you noted, Chris, the portion of new borrowers on DTIs of 6 or more hit a peak of about 25% in the December quarter. That actually came down through the March quarter. So already we see the effect of these kinds of interventions working. And absolutely, APRA's dynamic. I imagine that they can repeal that if they think that lending is at a more sustainable level.
Yeah, it makes sense as well. If you think about like if when you were confident the rates are going to be say 2 or 3%, you borrow up, you take on a lot of debt, and that's what's caused prices to go up. But when you're seeing fixed rates jump to 4s and 5s, you go, look, I really want to take this stretch. Let's just be a bit more conservative. Let's just buy an apartment, not let's buy the house, or let's not go for the really get our dream house. Let's just get a house that's going to suit us for 5 years. And so we've already seen that is that buyers want to reduce their budgets because they're worried about future rates, even though they could spend a lot more. So their borrowing capacities haven't reduced. So that sort of makes sense as well. I think the slower the market, the more concern around the market, the less people want to borrow. So going forward, I mean, what do you sort of suggest? Do you think that this is going to spread a lot to the regions as well, and you're going to see not only a capital city, because the regions have gone up a lot, A, because of COVID, but B, because of low interest rates, and potentially the return to work. How do you see it playing out in the regions?
Yeah, I'd be interested to know what you guys think as well, because I think there's a lot of unknowns right now. So it's not as if we can go to historical growth patterns and say, well, historically the regions have been slow and steady, because as you mentioned, through this cycle, they actually outperform the capital cities. We're seeing a trend at the moment where what's showing up in the data is that growth rates are softening across the combined regions, but they're not in negative territory yet, whereas capital city values are pretty much flat, falling in Sydney and Melbourne. But in some of the larger regional centres like Geelong, Newcastle, they've actually posted their first declines through the month of May since 2020. So they've started moving into that negative territory, not as much of a lag as we would usually expect between the capital city and the major regional centres. So it could be if people have been stretching themselves more to get into the regional markets, then they could show more volatility through this cycle as well.
It also could be potentially that if people have been leaving the major capitals because of affordability, and they've been looking at these other big regional centres, and they think, oh, I don't need to do that anymore. I might be able to stick around, and prices fall in Sydney or Melbourne, I can still buy there. Potentially that's one of the issues there, because if they're moving outside where they really want to be for affordability reasons, then the very first thing they're going to do is go, hang on a minute, I don't need to do that anymore. And we see that on a micro level and a suburb level, You even see it within a suburb. I don't have to buy on the main road anymore. I can buy on a nice street. So if the people are only going to move to Newcastle or Wollongong or Geelong or somewhere, for instance, because they think that they can't afford to be in where they prefer to be, whether they're moving away from Sydney or Melbourne to get there, they may turn around. But also I think that there's unproven, and we interviewed Simon Kustermacher recently. We were talking with him about this migration away from the cities and the working from home and the hybrid model and the expected U-turn that's going to come from some regional centres, as well as people sort of think actually long term it doesn't work for us anymore. So we don't know how that's going to play out, of course, because COVID's done weird things where it's accelerated a whole bunch of change, and some of it may have overshot the mark, like some of the prices in some of these regional centres probably has overshot the mark. Is there really the fundamentals and the newly formed local market, is it going to be strong enough to sustain those prices at the levels that they've achieved?
If you like what you're hearing here, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars, please. Every review helps make it easier for other people to find us and hear what our amazing guests have to say. We love hearing your questions and we're planning more listener Q&A episodes. Please send your questions in. You can send them via the website, which is theelephantintheroom.com.au, or directly via email to questions@theelephantintheroom.com.au.
Yeah, that's.
And I would imagine there's some areas that are more vulnerable than others. Have you got any research on that?
Well, as I say, I think that there are risks of those major regional centres becoming more volatile. I think you make a really good point about the withdrawal of demand, not necessarily people buying up in the regions and then being like, well, I'm going to move back. But as you say, people who may have been looking at regional Australia might not have to now if prices are falling in Sydney. So I think it's just going to be a wait and see the impact of the low interest rate environment and the change in the profile of the buyer on regional Australia, even in some of the more traditionally affordable regional areas, like Ballarat and Bendigo and, areas like that have just seen extraordinary price gains. I mean, overall regional value, combined regional Australian values are up around 40% since COVID.
Yeah.
Wow.
Yeah.
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 That's nuts.
Yeah, and some regions, which are more the commutable regions, are up a lot more than that, right? Saying combined, even the sort of second, third tier, I guess, outside of capital city, I reckon these building issues are going to, the costs of building have obviously jumped up a lot. I know you've got some info on how much and things like that you've seen, but there's such a big pipeline. They're already out there building a lot, but a lot of them have got a lot of work to already, locked in, more than ever. And so it's not like even if there is a slowdown in building, we're still going to see massive construction going on for the next few years. Maybe they're going to struggle to be able to sign people up because people are going to say, I'm going to put it on hold if I have to pay that. And, they're going to be less likely to go and do builds when they're not sure about the prices. But how do you think that's going to play out? Because it's a huge part of the market. If you can't buy a new house in the regions, for example, you're not going to move there, especially if you have to wait 2 years to build it, right? You're going to just buy something that's established, etc. So how do you see the new building dynamics playing out over the next few years? And
Yeah, so I actually think that this could be, in a perverse way, it's something that kind of offsets price declines because the construction pipeline has been so blown out in terms of cost and timelines. There are anecdotes, especially in WA, which not only had home builder but additional state government grants to incentivize new builds, which in retrospect is like, what were we thinking with this short-term unlimited scheme? Now on top of a global inflationary environment for the construction sector, we've created a domestic one with builders on fixed term or fixed rate contracts, and this has been this boom is presenting the risk of actually delivering no profit to builders as a result.
Well, that's what they're calling it, a profitless boom. And when I was watching something the other night, it's something like 160 building companies have folded over, is it the last 12 months? Like, is it a ridiculously high amount of building companies folding? And of course, now you've got this situation where if you are on a fixed price contract and just turning up to build whatever you've agreed to build, you're going to be losing money. They're trying to pay people to get out of the contracts, and it's a nightmare. And so, it's no good having your books full if you literally are losing money on every
you're having
nail
to
that you hammer in.
The cost on increased costs.
So I think the builders are now having those conversations with their client. And they're saying, look, I know we signed this and we said we'd build it for this, but no one could expect things that would change. You don't want us to go bust, especially if we've started this build. We're going to have to do a variation because, it's no one really wants to halfway through a build and the builder to leave. That's
on small scale builds. We've got, you've got like the Metricons of the world. They've had to go to their shareholders for cash injection. And there's other of those project home builders that have, how many dozens of houses and or hundreds even, some of them, that under construction that are at risk if they fold they're at risk of not being, I mean, they can't renegotiate with a first home buyer on a fixed price contract on a package, on a house and land package. There's just no more money in with some of those people.
Well, I think they will. I think they will because the reality is the first home buyer wants the home and they're going to say, look, where
are they going to get the money from? It's a first home buyer.
Well, they'll have to go back and get a bank and get a reval and get a new contract approved. And I think that's what you're going to start to see. These issues are really because the business is going to say, why would I want to build these if I'm going to lose money? And these are the pointy conversations. And it might not happen. They might not be able to get away with it 6 months ago, but now with all the news around building companies going under and, the fear, and they can potentially just delay it. There's clauses in their contract that they could say, oh, we can't get there. And they can say, well, we can, if we can't get more money from you, we're not going to build it anytime soon. And, leverage like that's going to start to play out. So it's a really, tricky situation for builders at the moment. Because a lot of people think, it's good for the first home buyer, but it's only if they get the house at the end of it, right? And it's built to the quality that they were promised and they didn't get shortcut on materials. Because things like that are going to start happening, right? Well, if you have to have a fixed price contract, are you going to use that type of wiring or are you going to go for the cheaper wiring? Are you going to go for that type of tile or are you going to go for this tile? And that's going to happen. So you're going to get already low quality generally. It's going to have to get built cheaper. And any cutbacks, are going to have to be made. So it's not going to be great for our housing quality at the end of it.
I guess like one ray of light is that some of the detached builds are starting to come off a little bit in New South Wales and Victoria. So the building activity data from the ABS showed a little bit of a decline off massive highs, mind, but through the December quarter, some of the houses under construction came down. And I guess that makes sense if we think about the home builder cutoff in March last year and commencement having to start within 6 months or 12 months or whatever they extended it to. That's finally starting to come off a little bit in the pipeline. And it's like that bulge that's kind of that we've got to move through. But yeah, it's just such a massive challenge. And I don't know. I mean, I guess the government would need to focus on facilitation of those builds coming through as well, especially from like an affordability perspective, if we want to talk about easing the market with more supply as well. Just getting...
Well, that is one of those two signs pointing in two different directions, isn't it? You need supply to ease affordability on rental level as well as, first home buyers. And then, of course, if you can't deliver supply because of inflation and supply chain issues and shortage of staff, all those other economic issues that come into play. But the other thing too, of course, that one of the reasons the government's just suddenly stimulate the building industry in the early days of COVID is really because of the great leveraging effect of the fact you got 1 million employees in the construction industry. It's a significant portion of our economy. You know what I mean? You stimulate that and everything kicks over just nicely. For every dollar spent, there's, the knock-on effect and the what do you call it? What do you economists call that?
Yeah, the multiplier.
The multiplier, thank you. So you can see why they did it. It was just short, sharp, quickly, desperately, grasping a whole bunch of straws, what's going to make the biggest impact and how can we get money flowing into the economy quickly. But yes, without much thought about the long-term impact. And so really, given that we have a rental crisis, given that, the immigrants haven't yet started really returning en masse, given that, we do have an affordability crisis on a number of different levels and we've got a supply crisis, I don't know, what can happen? What do you think could happen here?
I mean, for me, a lot of it just points to short-term pain in the rental market in particular, if we consider that overseas migrants are typically renters when they get here. And who knows how COVID will affect their settlement patterns. But traditionally, it's been inner city, Sydney, Melbourne.
Which we've still got quite high vacancy rates in apartments.
Funnily enough,
Sydney and Melbourne.
Melbourne's been a really interesting example where this very international city had rental vacancy rates, the inner Melbourne market had rental vacancy rates peak at 15%, which is huge.
So it's
But
double
it's
digit.
corrected, and it's since corrected to under 2%. Yeah.
Really?
Yeah.
So it's like
Wow.
between, I don't know, people moving to inner Melbourne to take up those cheap rentals and vacancies, investors selling off, the start of the return of migration. It's one of the most extraordinary, rapid
Wow.
corrections in the market that I think I've ever seen. And it's only, it could be amplified by increased return of overseas arrivals. So I see that as kind of the short-term pain point. And again, you get the reactionary population stuff we talked about, people adapting to those higher rents, moving around. And then if we look at, so the Australian Construction Industry Forum, they produce forecasts around dwelling completions. CoreLogic does a little bit of work with them in terms of supplying some of our construction data in that space as well. And they're forecasting detached construction to peak this year, and apartment construction, because apartments take a little longer to go from origination to completion, that to sort of peak midway through next year. So by the time we see all of those completions play out, that might help ease conditions a little, combined with the rising rate environment slowing demand right down. New approvals are going to slow down, if nothing else because of higher interest rates, but no doubt compounded by all the stress in the construction industry at the moment. So I think it'll sort of just ease off, but yeah, there is definitely some short-term pain.
I know that we've seen, quite significant reductions in mortgage applications across the board, and which is to be expected when you've got interest rate rises, or even just the talk of interest rate rises. Let's face it, the jawboning beforehand. So we've seen that, but we then get used to it, don't we? We get used to the interest rates as to wherever they will be. We've all been used to different levels of interest rates. I mean, all of us that have owned property been around for a couple of decades anyway, have got used to interest rates at certain times. I mean, I've been used to interest rates close to 10%. I've been used to interest rates at 6%, and certainly loved having interest rates around 2%. But we'll get used to it again if it's at 5, whatever. We will get used to it, and we'll just kick on, and our lives will continue, and we'll go back and we'll borrow money, and we'll upgrade our houses, and we'll do what we just do. And I guess human behaviour will take a while for that just to be the new norm, right? And so I actually read a report, an article written by the Cook, which went back to the last 4. It looked back at the last 4 rate hike cycles, and it looked at prices 1 year, 2 years, and 5 years after the first increase, and then after the last increase in each of those cycles. And overwhelmingly, prices continue to go up. There's a couple little dips, but the dips are small in the whole scheme of things. Now, I'm not one of these property people who say, prices always go up, because at the end of the day, you buy an individual property, you're not buying an entire market. But it is interesting just to see that we do seem to get used to it and get on with it.
Yeah, I mean, I guess the difference now is that debt levels are so much higher than they were over, historic decades when he's doing that analysis. So we've done some scenarios where markets are currently pricing in a lift in the cash rate of 4%, which I don't think is likely, but you're talking about thousands of dollars added to the cost of a mortgage each month off the back of that. So I think you've always got to consider not just what's happened historically, but what's a bit different this time around. And I think, there's no... Do people get used to that interest rate setting? Yes, I think they do. I think we saw that even through the current upswing, where growth rates were falling when the cash rate was still at 0.1%. But, as you say, we are in that softening period at the moment, and everything from clearance rates to days on market to listings volumes to the home value index itself is pointing to that decline, and it's been accelerating.
Yeah.
So I guess another consideration about the cash rate and property prices is how quickly the cash rate is moving, how many successive rises or cuts there are, because those can all have varied impacts on the cycle as well. Just something to keep in mind.
Yeah, I think you're right. I mean, it's so much volatility, right? Unknown, right? Whether it's an election or whether it's your job or whether it's, people don't like making decisions when there's not clarity, right? And so I think until we have a, real comfort, rates increases really slow down, prices fall a significant amount, that people start getting a bit more opportunistic and they say, well, actually, I could have bought last year for this price, but now it's this price. So actually, you know what? Yeah, rate prices could fall further. So, as prices fall, more demand's actually going to increase. And also supply is going to reduce as well. I know you said, Veronica, that sales have been very similar. The quality properties will come on the market less because people say, why would I sell this now when we upgraded our home last week, right? A counter-cyclical against the market, but we know that property we purchased, if this was in a hot market, there's no way that would not sell off market. It would go to auction. And go to an auction, trying to buy that in a hot market, no chance, right? And so, and that's the reality. We know that even if prices do fall, that property will probably fall less, and it already has fallen a little bit. And it's just going to be harder potentially to buy something in a downturn. And so, people are going to be, for example, they're being picky, they get 6 to 12 months into their search and they haven't bought a property, they're going to finally just say, well, we have been looking for 6 or 12 months. Yeah, prices have fallen, but nothing's come on. And this is the stuff we're starting to see with clients, is they're saying we still want to buy, but we just can't find anything. Yeah. And that's actually going to get harder over the next year. And they're reading the news that prices are falling 15, 20%, but they can't buy a property. And so, because nothing's coming on. So I think that's what we're going to start to see, is that, at some point the swing flips back, rates stop increasing, confidence, people just get on with their lives, like you say, Veronica, but they do change their budgets and they do change what they're willing to stretch for. And so we get repriced to the higher rates rather than to 2% interest rates, which we did last year. And it's just, we're in that sort of transition at the moment, like this peak fear. And that's what we're starting to see in equity markets. Equity markets are a good sign of consumer confidence, and that's why we've seen such big falls in the last week, is because fear is really just taken off right now. But at some point, the fear sort of subsides.
Yeah. I guess the other thing to keep in mind too is, at the national level, we've looked at what a 20% decline does to values, and it takes you back to where prices were at the start of 2021.
Yeah.
So, again, right. It's like, only recent buyers, and that's not nothing. There's been a lot of recent buyers. Transaction activity has been really high over the past couple of years.
Well, about 600,000 sales over the past 12 months.
Exactly, right. Yeah. So it could affect a lot of people, but at the end of the day, it is more recent buyers that are affected. Depending on what city you're in, of course. If you go back 20% in Perth, then you're back to like 2006. But at the national level and across some of those smaller cities like Brisbane, Adelaide, areas that have seen a big boom, it doesn't do too much to the equity position of most home buyers from that stability perspective.
I think, recent history for me is quite telling, and that recent history is what the Sydney property market did between the middle of 2017 and the middle of 2019. And I think we can look to that. It is recent history. It's not that long ago. Everyone seemed to forget it in 2021. Now they're all thinking it again, But you can't pay people to buy when it's the best time to buy. You just can't, like no one wanted to buy in 2018. Freaking awesome time to buy a property in Sydney. Awesome time. Those people would have made whopping great gains, but trying to time the market is a mug's game for starters, because most people won't do what's best for them, But as Chris said to you, you do have that challenge of trying to find quality property in that time. But, if you're active and you make the decision, I'm going to actually now take advantage of the fact that when I find that quality property, I will be fighting with less people.
Yeah, absolutely.
And you are. And that's what we do in our business. We literally bought a property the other night. We've been looking for these clients a bit longer than I'd like to, but they came on board, I think it was July, August last year. So it's taken us, a good 10 months to buy for them. And not for want of giving it a red hot go on a number of times. We were the bridesmaid more times than I really want to count. But we still had to call it off, say, no, it's not worth paying any more than that. But we bought this property, a really good, cracking house. So excited for them. Honestly, it was worth the wait. And we got it for less than we probably would have had to pay had it come on last year. But a big part of that was because they really quoted it too high. They really quoted it, and if the agent doesn't get the quoting right, then they miss the opportunity to build competition, and it's a much more sensitive market to that. So we just saw an opportunity in the fact that they had to cut the quote by 10%, and it's like brilliant. We got to buy it within the range that we priced it. It was a great opportunity, and I just think that had it been handled differently, it would have sold for more money. And so you could say, oh, that's falling prices, but that's actually a campaign that just missed the mark. You know, the agent got it wrong, had to correct, and it's very costly to get it wrong in this market. And so that's some of the ways in which it plays out, in that the market's not very forgiving for those sorts of things. And this is the thing, being in the market and understanding that gives insights into how you approach it, what you do, but still trying to get people to buy and make commitments in a falling market is nigh impossible. You know, like I think our annual revenue went down like 50%, you know, from the peak to the trough. It probably was probably about 50% down. So that's just
Eliza,
what happens.
Besides interest rates, inflation, maybe migration impact, is there any other things that you think that are really affecting that, and maybe borrowing capacity? What were some of the other things that you think are really affecting the market? And whether it's consumer confidence. I mean, that's like Veronica said, you know, the time to buy index is at its all-time lows pretty much, you know, like that's fear, I guess, in the market. What other things are you thinking in there that are sort of weighing on people's minds?
Yeah, consumer sentiment is a big one, which is at near GFC lows at the moment. It's it's pretty highly correlated with sales volumes, and it comes back to what you were saying earlier about people not wanting to commit to big financial decisions when they don't feel as confident about their finances. So a lot of that comes back to interest rates, inflation. It comes back to higher cost of living, uncertainty about, you know, global economic and conflict events. So that is a really big one. Affordability constraints, of course, which is tied into it all as well. I think, you know, at the moment we're still seeing a lot of listings accumulating on the market, in some markets more than others, but it is happening. Hobart looks like it's finally starting to turn. We're seeing an accumulation of listings there at the moment, and days on market are sitting at about 25 days for Hobart, where they were 9 days this time last year.
Wow.
So some pretty dramatic changes happening, and I think it really does come back to the credit environment at the moment. And the pricing of credit. I guess there could also be some of the government policies that we saw over the course of the pandemic period, maybe concentrated demand, brought it forward. So when you're bringing forward, for example, first home buyer demand, or, you know, whoever was taking up home builder, that could take away some of who starts to buy in the current phase of the cycle. And Australia is interesting like that. We've had a lot of volatility in our transactions relative to, I would say, some of the larger countries like the US and the UK. When you compare sales volumes, they're sort of relatively steady, whereas Australia has some pretty big fluctuations. I think those are the main things, and I think that it's, again, just part of the design. It's part of the way that the transmission of the cash rate works in reducing consumer demand and thus reducing inflation.
Yeah. One thing we're really seeing around price of credit is a lot of people think their mortgage repayment is solely based on their interest rate, but it's actually based on how long have you got left on your mortgage and plus the interest rate. So the shorter time frame, you know, if your mortgage has been 5-10 years old and you get increases to your interest rate, then you're going to feel the pain a lot more. But if you're, for example, refinance that mortgage to another 30 years, then that'll reduce your repayment, which will offset the increase in interest rates. And so I think what we're going to start to see as interest prices of properties have gone up, it's the ability to refinance is people have paid down their mortgage. They got a bit lazy with it as well because, you know, they've done other things. And the loyalty tax is getting big. So they start looking at these interest rates and go, well, maybe they fixed. So they come off this fixed rate. They've got a 20-year mortgage. They've stayed with their Westpac for the last 10 years. But then they go, you know what? I'm paying a pretty poor variable rate. why don't we refinance, and why don't we refinance to another bank and extend our loan term to 30 years? And that'll really reduce their repayment, which will offset increases in interest rates. And so the banks are freaking out at the moment because I was at this conference and chatting to all the heads this week, and I was asking them pointy questions, and they were like, didn't know what to say. But, they've got all these fixed rate loans coming off, and they've got all these customers that are wanting to refinance and that are swapping banks. They're literally swapping colours, and they're getting better deals and becoming lower profitable customers to the banks. And it's going to happen en masse over the next couple of years. And so not many people are thinking that through, in terms of the impact of interest rates, because they're saying, well, interest rates are going to go up. Everyone's going to be in pain. Well, no, everyone's going to refinance their mortgages onto longer loan terms and then get a better variable rate in terms of a discount, which is going to offset the increase. So you can actually reduce your interest rate maybe 50 to 80 basis points just by refinancing to the best deal in the marketplace today, if not more. And so even if interest rates go up, 50 to 100 basis points, well, that doesn't matter because you just got yourself saved that in interest rate by swapping banks. And so, that's something that's seeing. The other thing we're seeing is we've got a lot of clients in the tech sector, and the tech sector hasn't been doing very well, right, in terms of their share portfolios. So they work at Twitter, or they work at Atlassian or Google or Facebook, etc. And, one thing that gave them confidence to take on big mortgages and gave them the deposit for that was their portfolios in the tech sector. And they've been absolutely smashed. And so I think equity market falls also correlate quite strongly to residential prices. And so I think that's going to start to have an impact. And even things like Bitcoin, Bitcoin's 30,000 now versus 80 plus, right? We've got quite a few people coming into the market over the last few years who have made a lot of money in crypto. And, those sort of things. So that's what's been really torpedoing the market up is equity markets rising as well, because people have been making money there and putting it back into property. And people selling businesses, if you tried to sell out of private equity in the last few years, you would have made a lot of money, for example, if you started a business and sold it. But, like Canva, for example, it's nowhere near what it was worth last year. And so that's also affects the top end. So I think there's lots playing out in the market that is as this downturn increases, they start to, multiply.
That's so interesting you say that as well, because there's that's some of the theory behind why the top end falls first as well. Even compensation structure of people who tend to be in more wealthy areas of a city, if their compensation is more tied to bonuses or firm performance or whatever. So I don't know that there's anything rigorously demonstrated, but I think those anecdotes and those kind of stories definitely tend to track.
Yeah, the interesting thing about wages and bonuses, we're not really seeing that too much. If anything, we're seeing the opposite. So when I'm tracking these, they're getting pay rises. They're swapping jobs because they, when you swap a job, you go for more money, generally. And so mobility, I think, is going to pick up. Low unemployment, and people have wanted to stay in their jobs through COVID. They've got the confidence now to swap jobs, especially if they're not giving the flexibility they want, etc. And so we may see these, more wage increases just because people are swapping jobs. But maybe their share portfolios are going well, maybe et cetera. So maybe the company's still doing well financially and can keep paying bonuses. And so there's so many levels to it. But
I remember at the beginning of COVID, the lockdowns there, and the share market tanked, of course, was it March 2020, and I had some clients that were looking at the upper level for their homes, high $7 million budgets, those sorts of budgets. And I said to them, well, look, this will be interesting because if people are relying on, if your competitors in this price bracket are relying on money from shares or converting money from their share accounts or whatever to help fund their property purchase, they're going to be out of the market. They're going to be really severely impacted. Their borrowing capacity is going to be impacted. Their actual deposits are going to be impacted. But you know what? That segment of the market actually, I think, was stronger at the beginning of COVID, in my experience anyway, that upper end, despite the fact that the share market tanked. It was really interesting. I thought it has had zero impact. In fact, potentially the opposite impact. But anyway, that was just because that was what I expected to see happen, and it certainly didn't play out that way. Anyway,
Eliza, have you got a property Dumbo for us? We probably asked you 7 of them.
I know, and it's so hard.
It's like a whole. It's a herd of elephants you need to give us now. But have you got one for us?
It's tricky because, like, I think for my demographic in Sydney, I still don't know that many home buyers, you know. But I do, if you would allow, have a bit of a property savvy story. A friend of mine who purchased their first home with their partner, which was had their heart set on Gladesville and could not get in, missing out at auctions, feeling devastated. And their partner's saying, let's look in Ryde. Let's look in Ryde. So for people not in Sydney, I guess it's kind of comparing like a bridal and a bridesmaid area, kind of. Would you agree?
Yeah.
And
are they looking at house or apartments?
Yeah. So my friend, they're getting really upset. Their partner looks at them and they sort of say, I can't believe we can't get into Gladesville. And the partner says, well, imagine how you're going to feel in 5 years' time when we can't get into Ryde. So that was the mantra that they repeated to themselves, and they bought a home in Ryde. They've renovated it. It's beautiful and they're really happy. And I thought that was a really interesting piece of perspective and something that I'll definitely take with me on my property journey as well.
That is a classic.
So they bought an older apartment, just getting a few more details. They bought an older apartment.
Correct. It's like 70s or 80s by the looks. Yeah.
Excellent. Yeah. Not one of those new monstrosities.
Two better, but it's a good size for the two of them. And the partner's a builder as well. So the work that they've done on it is just gorgeous. Yeah.
Excellent. Yeah. I've got actually a Dumbo I can add to that, which is about Gladesville and or in that area. Anyway, we had a student on Home Buyer Academy who successfully bought her first home in Gladesville as an apartment, and she in the process of there was a number of buyers on it, and she'd had to pay over a certain figure. And the owner, the Dumbo is that the owner of the property was living overseas and hadn't realised there's a threshold over which if the property sells at a certain price, they have to pay a much higher rate of tax. And so they ended up working that out afterwards, after it was in the cooling off period, I think. And then they had to renegotiate the contract. She got it for less than she offered because they brought it back underneath the threshold.
That's great.
So talk about someone almost accidentally having to pay a bunch of tax they could have avoided. But the classic, she got to buy it cheaper because of so I don't know if the Dumbo is the government putting that threshold in, not phasing it in. The owner themselves listing the property and not understanding their obligations. It's a good example of people not getting advice from the people they need to get advice from before making these big decisions. But I just thought that was a classic story.
And good news for the buyer.
Absolutely.
Yeah, absolutely. And maybe we need to change these from property Dumbos to maybe, I don't know what we're going to call it, but, the good news stories. We've maybe done 250 Dumbos. Maybe we need to start talking about the positive wins rather than all the negatives. So thanks so much for coming on, Eliza. We're obviously going to get you coming back soon on some other reports. So we'll leave that up our sleeve. But, thanks so much for coming on.
Thanks for having me, guys.
If you're looking to buy your dream home or an investment property in Sydney's inner west, eastern suburbs or North Shore, my team and I can help you buy without regrets. Reach out via my website, gooddeeds.com.au.
If you're looking to buy your first home, thinking of upgrading into a new one, or purchasing an investment property anywhere in Australia, my team love to carefully guide you on this journey. And most importantly, get the finance right. Reach out via our website, wealthful.com.au. Thanks for joining us. We'd love to see you again.
And remember, don't be a Dumbo.